When Michael Burry successfully predicted the 2008-9 real estate and stock market crash, he was harassed by the government and had to pay over $1 million in legal fees to defend himself. Instead of acknowledging his efforts to warn millions of Americans of the dangers ahead, he suffered both emotionally and financially. The US government should have made him the chief economist instead. Listen to what he said.
I saw the crisis coming. Why did not the Fed? Never did any member of Congress, any member of government for that matter, reach out to me for an open collegial discussion on what went wrong or what could be done. Rather, within 2 weeks, all 6 of my defunct funds were audited. The Congressional Financial Crisis Inquiry Commission demanded all my emails and lists of people with whom I had conversed going back to 2003. And a little later, the FBI showed up. $1 million in legal and accounting costs and thousands of hours of time wasted, all because I asked questions. It seemed they would pump me at gunpoint or not at all.
Well, today, I have the same feeling. No one is heeding Michael Burry's warnings about the United States and the global economy. Whether or not all economists agree, the US and the global economy are headed for recession. One way or another, the global economy is in great danger again. What's certain is that the economy and stock markets make no sense and are in disarray for the foreseeable future. Negative or even zero growth in the corporate earnings makes a global recession increasingly likely. Even JP Morgan recently warned that the market could fall another 20% from current levels. The recent volatile sideways movement has caused stock prices to start moving in unpredictable ways, dropping sharply in a few days and then bouncing back the next day. While everyone seems confused about a recession, stagflation, hyperinflation, or a crash, Michael Burry is back with his latest clear predictions. As a contrarian, he saw the subprime crisis come first. Now, Michael Burry argues that inflation will only get worse from here, wiping out any market gains people may have achieved in recent years, but surprisingly, this is just the beginning, with no end or bottom in sight. Let's talk about what's happening now. Why is the stock market plummeting, and what is Michael Burry's latest warning? Looking at the current trading environment, Michael Burry is urging investors to expect a rally in the final quarter of winter. A market rally is when the stock market rises by at least 5% during a downtrend and is a common bear market practice. The 1901 to 2015 bear market saw gains of at least 5%. Given the current scenario, it's clear that history is repeating itself. We can also see that the deeper the drop, the more difficult the recovery. For example, the Dow Jones rose about 48% in 1929, but before that, it had fallen 86%. Similarly, the dot-com market has risen 18% in bear markets 8 times, with 4 of them up nearly 30%, but before that, it was even lower. The greater financial crisis of 2008 also triggered 9 bear market rallies ranging from 6 to 24% before bottoming out a few years later. At the bear market rally, Michael Burry found that since the market peaked at December 31st of last year, it had fallen 8 to 10%, then climbed 5%, dropped another 8 to 10%, and then dropped 5% again. However, Michael Burry stated, dead cat bounces are the most epic. 12 of the top 20 NASDAQ one-day rallies happened during the 78% drop from the 2000s top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top. He also shares that the Dow has 10 bear market rises. So in 1929, he was over 10% before plummeting to 89%, and he suggests it may take some time to bottom out. Historically, no bear market has bottomed out without reaching a certain fixed level of 45% or higher. Recent history has proven the same, and you can often observe that the VIX peaked at 70% in November 2008 and bottomed out just 3 months later. The VIX reached 57% and 65% at the same time in March 2020. When judging stock market bottoms, Michael Burry has a few other points worth considering. First, he said 13% of stocks closed above the 200-day moving average. Typically, as seen again in 2009, 2011, and 2020, this figure hits an all-time low when he approaches 5%. The only exception was the dot-com crash, which was mostly focused on high-growth tech stocks. Second, he said there are 218 or more companies worth $1 billion that are losing $100 million a year, and 29 companies worth $10 billion too are facing the problems of a market capitalization that cannot be profitable. These companies include Uber, Snowflake, Lucid, Rivian, Shopify, and more. If this trend continues, the same pattern that the market didn't bottom out in 2008 will continue for several years. Worse, as he said, inflation will continue to skyrocket, disappear, fool people, and then come back again. The chart shows that inflation has never occurred since the 1940s and has disappeared completely. This is all due to the velocity of money back and forth. For example, if you spend $10 at a restaurant, who then pays $10 to the server, who spent $10 at a grocery store, who then pays $10 to a wholesaler to pay for more food, who then spends $10 to a farmer to make the food, who then pockets the money to invest GameStop, all this works out to be a money velocity of 5 because it changes hands 5 times. It shows how many times each dollar is consumed and recycled throughout the economy. That's why Michael Burry says the Federal Reserve is pulling money out of the economy at higher interest rates. Inflation will continue to rise because of all this. Michael Burry also explained that the price of 1 in 10 homes has fallen the most since 2015, increasing pressure on the housing market. But the good news is that this is a great buying opportunity. If we don't add the drop of less than 20% on average, the bull market lasted for over 9 years with an increasing return of 476%. On the other hand, if we include the 20% declines, which seems to be minor along the way, the average bull market still lasts for an average of 4 years with heightened returns of 129%. The Wall Street Journal published an article saying that the bear market is headed for an upside. They observed the biggest rebound after the worst decline since the 1990s, but that doesn't mean the upcoming bull market will last for 2 years. And that's because going back in history, the shortest bull market since 1940 occurred shortly after dot-com's crash. That was when the market surged 21% over a 3.5-month period before bouncing off its imminent course. 9 months later, during the Great Recession, it had a month-and-a-half period during which the stock price rose 24%, but after a few months, it fell 27%. However, it's an accepted fact that bull markets last longer than bear markets. Such volatility levels are normal, with regular gains and drops of 20%. We also see that stocks can fall by up to 36% in bear markets and rise by 114% in bull markets. Burry believes that free cash flow has been completely sold and ignored during past momentum stock declines, but not enough, and beloved companies still have a lot to lose. Yes, its value is about to rise over the years, despite more accidents along the way. A boring company, he suggested, is one that outperforms in the short term. An oversold condition in the stock market could act as a catalyst for a modest rally. Better than expected earnings can trigger a market rally. People are spending more money or reduced inflation in the coming months. Home builders are gaining more and more confidence. Therefore, be cautious in such a market and plan for the worst. However, don't modify your investment strategy around the plan that may or may not happen. We've seen more people losing money planning for the crash, which is inevitable as compared to those who consistently buy in dollar cost average without thinking about what's going to happen. The main goal must be to see ways to increase your income as much as possible over the next 1 or 2 years. Even if the market drops, you have enough resources to benefit from the lowered prices.